Hello and welcome to the Business Today show. I'm Udayan Mukherjee. These days, global financial markets are in a state of great turmoil. As central banks across the world try to tame inflation, there is a real possibility and danger that next year many of the large global economies will get tipped into recession. How will stock markets do in this kind of a backdrop? No one knows the answer, and there is considerable uncertainty about whether this inflation beast can be tamed in time, sometime in the next few quarters. Who better to talk about all of this than a real veteran of the stock market who's watched many such cycles and many such bull and bear phases. Mark Mobius is not just the legendary fund manager of Templeton, he's now founding partner of Mobius Capital Funds, and he joins me on the Business Today show today. But Mark, it's a pleasure to speak to you again. And as I was just describing, this is not the first bear phase that you are witnessing in your career. You've seen so many of them, from the 2008 global financial crash to the tech bust in 2000 and even before that. Where would you rank this period in the scheme of the great problem patches that you've had to negotiate in the stock markets over the last many decades?
Well, this is relatively mild when you look at it from the perspective of history. You must remember, we were dealing in the markets in Brazil when inflation was 2,000%, and Argentina and places like that. And of course, history in India also was very checkered in those areas. And of course, you had the Asian financial crisis, which is very, very severe. So I would say this downturn is relatively mild, at least at this stage, and we can pretty much handle it.
The caveat in your answer is at least at this stage. The fear is that it might be looking mild now, but the way the central banks are acting, it might get out of control very easily next year. What would you say is the probability of that?
Well, I think the good probability of a higher interest rate is still there. The Fed in America, the Fed really leads the world in terms of interest rate hikes, with probably the exception of China. But if you look at the Fed and their desire to tame inflation, which is now running, the CPI running at about 8%, their playbook says if you want to tame inflation, interest rates have got to be higher than 8%. So that means they're going to go to 9%. So when people talk about, 0.75% is such a big problem, no, this is relatively minor. The rates will go much, much higher. If, of course, the big if the CPI stays at this level.
Yeah. So do you think that the Fed is panicking about inflation at this point in time? It realizes that it might have made mistakes in the last 1 year and is trying to compensate for it. Is there a fear in that sense of an overreaction from the central bank?
Yes, I think they realize that they are late. They should have moved much earlier, and now they're trying to catch up. The problem they're facing, however, is that unlike in the past, you didn't have cryptocurrencies running around. I had a recent trip to the U.S. visiting various states, and people are spending like crazy. And one of the reasons, of course, is that they still have money left over from the handouts that were taking place during the COVID crisis. The current administration has released oil from the strategic oil reserves, which mean gasoline prices have come down. And that makes people feel very happy and very rich in America, because gasoline is so important. And then don't forget the cryptocurrency. Cryptocurrency probably represents 2% of the money supply. And the velocity, although that's 2% is small, the velocity of this money is very, very high. And people are spending. Another very interesting note in America is that the unemployment rate is so low. And we noticed a lot of companies, a lot of restaurants looking for workers. They're just not around. What does that mean? It means people don't want to work. They've got enough money to spend and to live without having to work. So it's going to be very, very difficult for the Fed to tame inflation, in my view.
Now, you have a long memory, Mark. You may even have been around in the financial markets in the 1970s as a young man. At that point, inflation actually reigned for many, many years, and the Fed was unable to tame it. And All of us have read how bad the economic and the financial market situation was then. Do you think, I mean, what you just said about inflation, we run a risk of that kind of a protracted inflation period, or would that be alarmist to think about it at this point?
I don't think it's alarmist to think about it. I think we've got to live with high interest rates. And by the way, high interest rates don't necessarily mean a downturn in the stock market. It could be temporary. Of course, the stock market is now reacting negatively to the possibility of higher rates. But if you look at the history, you'll find that stock markets were able to do quite well even with high interest rates. And of course, that means you've got to find companies with pricing power, companies that are able to raise prices in line with the higher inflation. But there's no question that the Fed could go much, much higher, and there could be a lot more pain ahead, provided that the CPI stays at this level or even goes higher.
Your point is taken about interest rates not necessarily meaning a stock market downturn, higher interest rates, but the way interest rates are going up this time, it seems like most of the global economies might get tipped into recession, and that has ramifications for the stock market, at least in the foreseeable future. Do you see that as a real risk, or do you think recession might be averted in some of the major economies?
Oh, yes. I mean, I think the possibility of recession is definitely there. In fact, if you take the official definition of recession, we are already in a recession in the U.S. because you've had 2 quarters of negative growth. So we are in a recession, but a recession does not necessarily mean that people feel poor. You're going to find that these two things are quite different in many ways. And yes, a recession is hitting companies, and of course the stock prices decline because their earnings go down. But this could be quite temporary once these companies are able to raise prices again.
What does all this mean for currencies, Mark? I mean, the stock market is one part of the equation, but there is a huge flux going on in the currency world. I mean, where I sit in London, the pound has collapsed over the last 1 month. We are seeing many such reactions, even in the euro versus the dollar. How do you think this part of the equation will play out between the dollar and the other major currencies?
That's quite remarkable when you think about not only the pound sterling, but the euro. Look at where the euro went. It's quite remarkable. And what does that mean? It means that imports for these countries in Europe and the UK are going to become a lot more expensive, more difficult, because usually these imports are denominated in dollars. It means that the US, of course, can import a lot more cheaper. And the rest of the world, of course, is under pressure because you see all these currencies are weak against the US dollar. Indian rupee actually has been holding up fairly well, but if you look at other countries, it's been pretty much of a disaster for many of these countries. But you must remember that even in situations like this, you have companies that can do quite well. For example, in Turkey, companies that can export and receive dollars, and their costs are in Turkish lira, which is devaluated massively against the US dollar, these companies can do quite well. So it's not a complete disaster for everyone, but it's certainly something that's quite remarkable when we see the major currencies decline against the US dollar to such an extent.
The fear, Mark, at such times is that one part is how the macro plays out. The other is because of what is going on in the world of interest rates, in the world of currencies, that at some part of the world there will be a financial accident. And this kind of collateral damage. Do you see the fear of that? Some kind of accident which dislocates the system and something like a 2008 situation pans out?
Definitely. When you see prices move in such a remarkable fashion, where interest rates and where currency rates move in such a fashion, then there's a possibility of a big accident happening. I know you've heard rumors about Credit Suisse being in trouble. Yes, it could happen where Credit Suisse has been gambling on foreign reserves or on currency, on interest rates in some ways, with all these derivatives. Banks can get into big trouble if they're playing around with these instruments. So yes, there's a possibility of an accident. I'm not saying that Credit Suisse is in trouble. But I'm just saying that you could have a major bank like that having a real problem, and then that would create a panic.
Now, we are talking about inflation, interest rates, and financial accidents. What about geopolitics? I know the Ukraine war has been raging for some time now. The market might have priced in quite a bit of it. But, I mean, where you sit, closer to that, there is always the China-Taiwan thing which is simmering. Do you think something might explode on that front and bring geopolitics back into play as one of the key risks for the market sometime in the next few months?
Well, I think it's a very important point you make, and that is these geopolitical issues are really at the top of the agenda. I mean, we can talk about interest rates, we can talk about the stock market, etc. But when you have a war going on in Europe and the possibility of Russia using nuclear weapons, then you really got a crisis, and that could wipe out everything that we've worked for the last 50 years. So it's a real problem. And of course, the China-Taiwan situation has simmered down, has quieted down a little bit, but there's no question that continues to be an issue going forward. I don't see the Chinese taking military action against Taiwan in the foreseeable future, but the threat is always there. And particularly if Russia is successful in Ukraine, then it might encourage other countries to try the same thing.
What are your thoughts on China, Mark? Because, you know, we are talking about a global economic slowdown. Clearly, there's a possibility of recession in the US. Many European countries are already staring at recession. China becomes important at a time like this in deciding whether the world gets tipped into a really big slowdown or it manages to amble along. The numbers coming out of China over the last quarter or so are not very comforting. Where do you stand on how the Chinese story will play out in the next year or so?
Well, first of all, you can't ignore China. It's either equal or a little more or less than the U.S. economy. So you just can't ignore China. And you can't ignore Chinese companies. We continue to look at Chinese companies to see where the opportunities are. But then, as you mentioned, some of the numbers don't look very good. As you know, they've had a property or housing crisis recently. And one of the reasons why Chinese investors are somewhat depressed is because most of their assets are usually in property, not in the stock market. And when property prices go down, they feel poor. So all of these issues, including the COVID lockdown, has hit China. Foreign investors have been burnt badly. American investors had a lot in China. As you know, the Chinese market represented, or still represents, about 30% of the major indices. And over 50% of investors in emerging markets go into these index funds. So when China goes down, they all get badly burnt. And of course, Russia being eliminated from the index somewhat means that they've lost 7-8% of their portfolio overnight. So all of these factors make people very wary of China. But that does not mean that there are not opportunities there, and we continue to look.
A quick break at this point in time, but we shall return to talk about global markets and where they're headed over the next 1 or 2 years with the legendary investor, Mark Mobius.
An extreme heat belt is going to impact over 100 million people. The research was conducted by First Street Foundation, and it says that by 2053, an extreme heat belt will impact people across the US. This will cover regions stretching from Texas, Louisiana to Illinois, Indiana, and Wisconsin. Heat index, or apparent temperature, is what the outside temperature feels like to the human body when relative humidity is combined with air temperature. A key finding from the study was that heat exceeding the threshold of the National Weather Service's highest category called extreme danger, or above 125 degrees Fahrenheit, was expected to impact 8.1 million people in 2023 and grow to 107 million people in 2053. The biggest predicted shift is in the local temperature of Miami-Dade County in Florida. This county currently sees 7 days per year as its hottest temperature of 103 degrees Fahrenheit. By 2053, this number is expected to increase to 34 days. The study predicts that temperature spikes are a result of using air conditioners. The study warns that this will lead to more frequent and longer-lasting high temperatures. The study used satellite-derived land surface temperatures and air temperatures between 2014 and 2020. This helped them understand the relationship between them. It also looked into elevation to see how much area is absorbed by water and distance from surface water to the coast. The model was scaled to future climate conditions. It used the middle of the road scenario. The report says that these increases in local temperatures result in significant implications for communities that are not acclimated to warmer weather relative to their normal climate.
Welcome back. You're watching the Business Today show. I've been in conversation with Mark Mobius, formerly of Templeton, and now the founder manager of Mobius Capital. Let me ask you to wear your global investor hat for a minute and tell us, what do you think large global investors are thinking at this point in time, or would be thinking at this point in time? Because you've run billions of dollars as a global investor. Would they be thinking that this is not the time to be adventurous and up allocation to emerging market equities? Maybe it's better to be in the safety of home in US dollar assets where bond yields are inching higher. Would there be a propensity to take money back into the home ship at this point in time?
Yes, that's already happened. You know, one of the reasons why these interest rates have been attracting people back to the US market is because with US dollar deposits, they can get a lot more and equal to what they've been getting anywhere else. But the other important factor is that people in other countries that were holding local currency debt or local currency assets want to get rid of those assets and move into US dollars. So that's the reason why you see this incredible strength of the US dollar. The other factor that you must look at is a lot of people have been burnt in the market and therefore don't want to talk about investing more in the market. We haven't really reached the end, however. I think there's still considerable optimism in the market, and I think it probably would take another leg down to really make people very despondent so that they're in the process of selling despondently. In other words, giving up completely on the market. We haven't seen that yet, but this could come. So it's a very interesting phenomenon that we have now where, as I mentioned, at least in America, people feel quite wealthy, they're traveling and so forth. If you look at, even in London, if you look at the hotel rates and prices in general, they have not come down, they've gone up. So there is still a considerable flow of money. So we haven't reached that point where people are giving up completely and saying, look, that's it. But there's definitely a move, or has been a move, into US dollars.
Now, this is a very interesting point you make, Mark. I mean, having seen so many bear cycles in the past, you've just said that sentiment indicators, according to you, are not indicating a bottom, that you have not seen the kind of pessimism yet, which is consistent with markets having bottomed out.
Exactly. It's interesting that I mean, by definition, we're now in bear markets in most markets around the world, but I don't think we've seen the end there. In other words, a true bear market is when people have really given up and are just dumping everything into the market and just saying, look, never again, I don't want anything to do with stocks and so forth. We haven't reached that yet.
Are you talking about the S&P out here, or are you talking about the Nasdaq? Because the Nasdaq was the first to lead the fall, and there the stock price collapse has been quite brutal. Do you think the Nasdaq has sort of made its bottom, or do you expect techs to lead the slide like it did last year?
No, I think tech's already had it. They've already had the big downturn. You must remember that Nasdaq has outperformed the S&P for a number of years. So even those that have seen this downturn are probably above what they would have been if they were just in the S&P 500, let's say. But I would say Nasdaq has already had it. We've already seen that decline, and the next leg will be with the S&P. And by the way, don't forget Bitcoin and the cryptocurrencies. Bitcoin would have to go down quite a lot if the pessimism continues and increases. And that could be a very good leading indicator, let's put it way, for what's happening in the stock market. So we watch the Bitcoin prices very, very carefully because we just don't know where they're going to go. We're now roughly at about 19,000, 20,000, but it could go down to 10,000. And that would be really a very, very pessimistic scenario for many people.
How would gold do in a scenario like this, the one that you're painting? Bitcoin down to 10,000, another big leg down for the S&P 500. How do you see gold faring?
I think gold will do fairly well. It'll be fairly steady. I'm not saying gold would go through the roof, but I'm saying that gold will probably hold its own and perform better in such an environment.
Now, sitting in India, a lot of people are actually very enthused by the relative outperformance. Some see it as a risk that India has not fallen anywhere close to how much even the S&P 500 has fallen this year. But some take comfort from the fact that India is actually standing out and being so resilient as a market. How do you see this cookie crumbling? Do you see the relative outperformance continuing, or valuations actually acting against India in the next leg down, which you expect to come?
I think India will continue to outperform. I'm not saying that the market won't go down. If there's a global downturn, then India, of course, will be affected. But India, I definitely will outperform. And part of the reason, of course, is the fundamentals of the Indian economy. The Reserve Bank has done a fairly good job in managing the money supply and so forth. And most importantly, the government has moved to improve the investment conditions. And so they're attracting more and more high-tech manufacturing that is now in China and elsewhere to India. And this so-called Gati Shakti program to speed up approvals and speed up the government bureaucracy in India is going to be incredible. It's going to have a big, big effect and a very positive effect on the Indian economy.
And where would you be positioned, Mark, as an investor in India? I mean, if you were running emerging market money now and you said, this is an outperforming market, I want to be here, what would you buy? Because traditionally, large global investors like you have bought IT and banks, the two big sectors in India. But IT has come under a cloud because of the global headwinds. What would be the right way to be positioned at this point?
Well, we still like software. We still like Indian software. India is a leader now globally in the global software market. And I think they will continue to improve, and there'll be lots of opportunity in that area. The other is infrastructure-related stocks. Stocks in, for example, tubes, pipes and tubes. Stocks in any supply of relatively high-tech kinds of things for the construction industry. I think that would be a good area to be, because a lot of the infrastructure projects in India will be accelerated as a result of the new government policies. So I would say those would be the two areas, and possibly in healthcare, because more and more Indians are taking advantage of better healthcare, and they have the money to do so, and that would be a growth area.
When you say healthcare, do you mean hospital chains, diagnostic companies, those names, or pharmaceutical companies?
Diagnostic and hospitals, most importantly, and a few selected pharmaceuticals.
Right. So sum up the global situation for us, Mark, now. I mean, what is your base case assumption that this, over the next 12 months, it still is a market where it's difficult to make money for equity investors, that this bear market actually extends through the next 12 months? Because the last 12 months have been flat for equity market investors. They have not made any money. Do you expect one more year of pain ahead?
I think perhaps a half year of pain ahead. But you must remember, even in this painful situation, there's money to be made. As I mentioned, if you have companies that have good pricing power, strong balance sheets and so forth, they're going to take market share away from their competitors, and they're going to do very well. So, if the index is going down, it doesn't mean that all the stocks have to go down. So, but generally speaking, yes, there's probably more pain generally in the index ahead. And one of the reasons for that, of course, is the Ukraine situation. You must remember that the Ukraine situation could get worse before it gets better. And that could have a global impact in many, many different directions. Of course, there are winners and losers there as well, because although Russia is going to be selling less gas and oil to Europe, other countries will be selling more. So that probably is one of the reasons why the U.S. dollar is strong, because the U.S. dollar has become an important currency to buy oil and gas from the U.S.
Mark, always a pleasure to hear your thoughts. Thank you very much for taking time out for us today and speaking about such a whole range of issues. Thank you very much indeed.
Thank you.
A shocking revelation has rocked the chess world. An investigation has found that Hans Niemann, the American grandmaster, has cheated more than 100 times. A 72-page report conducted by chess.com found that he likely received illegal assistance in more than 100 online games, even in games where prize money was at stake. Suspicion rose when 19-year-old Niemann beat the world champion Carlsen while playing with the black pieces at the $500,000 Sinquefield Cup. He ended the world champion Magnus Carlsen's 53-game unbeaten streak in classical over-the-board games. Carlsen first suggested, then outrightly declared that this American was winning through illegitimate means. Niemann's explanation was that he had somehow guessed what opening the opposition would play. Carlsen abruptly withdrew from the tournament as a sign of protest, suspecting that Niemann indeed was cheating. Niemann first denied those allegations of cheating, but later confessed to violating the rules of fair play at least twice in random games on the chess.com portal. The investigation made no conclusions regarding Niemann's over-the-board games, but flagged contests from 6 of his in-person events. The investigation further revealed that Niemann privately confessed to the allegations. Chess.com used cheat detection tools that analyzed and compared moves to those recommended by chess engines, studied the player's past performance and strength profile. It monitors behavior